Hi, my name is Malcolm Baker. I'm Group Head of Sales in Europe for EQONEX, and today I'll be presenting the masterclass on spread trading. I have over 30 years trading experience over banks, hedge funds, high frequency trading companies. I am a particular late starter in the crypto space. However, what attracts me to the crypto space right now is the huge potential in arbitrage opportunities, that traditional finance strategies fit nicely into this crypto market. So it's extremely exciting for me to be part of the digital assets market. So spread trading is typically where you long one contract and short another. A lot of people will put spread trades on to mitigate risks. So this is why they call spread trading a lower risk strategy. So essentially, if you're longing Bitcoin, short another Bitcoin contract, you'll be long the spread. But what you're doing is at the same time as you're buying, you're selling exactly the same time. So a spread trade is something where you're looking to take the difference out of the price difference out of two contracts. You're looking to see if one outperforms, one goes higher more than the other contract, and that is a spread trade. So a typical spread trade right now would be where they would trade, say, a dated future in Bitcoin, and they'll trade that against spot Bitcoin. Now, the argument and the theory and the practical evidence shows that in an upward Bitcoin moving market, the futures contract, the contract further out, will outperform or go higher more than the price of spot Bitcoin, right? So what people will do, an example of a very, very simple trade would be if you're bullish for Bitcoin, you would buy the futures contract and sell the spot contract at exactly the same time. So you're not interested, it might be a little bit confusing because you're actually shorting spot, but actually you're buying a contract that will go up more than spot Bitcoin. So that would be an example of a bullish contract. Conversely, if you feel that the price of Bitcoin is too high currently and you think it's going to come down, a spread trader would put on a short futures position versus long spot. And then if the market did come down, the short position in the futures contract would go down more than the long position in the spot contract. And these are spread trades. This is how you would make money in a very simple way out of spread trades. There is no risk-free trades in trading. However, there are certain trades which mitigate your risk. This is why a lot of spread traders like spread trading, because they can trade and they can actually have a viable business model, i.e. spread trading, that should work. So are you making good trading decisions? An example being where you would be buying the spread because you believe the price is going higher, you would buy the futures and sell the spot. Now, let's say, for example, we're making the argument that there is no risk in that trade. That is not the case, because if you bought the futures and sold the spot, i.e. put on a bullish position, if the outright Bitcoin and the Bitcoin market comes down, you will actually lose money. But the beauty of spread trading is you're going to be losing much less, far less. This is why people like spread trades, because it actually lowers their risk profile. And so therefore, people feel a lot more happier getting involved and trading these trades. However, there is an argument, right? So there is a trade in spread trading, whereas if you sell the FAR contract, let's say the December future, and you buy the spot, by the time, because these are going to be the same contracts in time, but just at the moment they're valued differently. But in time, these two contracts will converge to one another. So when it gets to the expiry, they will converge at the same price. So in theory, as long as you can maintain the volatility in the P&L, that the market could move against you, at the point of expiry in December 31st, a couple of days before, these two contracts will be trading the same price. So an example here, currently that difference between spot and the December contract is 1800. If you sold 1800 and just let this position ride until December, you're going to make that 1800 profit. First of all, you need to find an exchange that has spot and futures listed, okay? So once you've got that and you're happy with your fees and your setup, the first thing is to start, how do I actually see and view these particular trades? So you need to, for a spread, you're looking at, so imagine you've got spot Bitcoin, you've got a dated futures Bitcoin price on a chart. You're not going to be able to easily monitor these particular spreads. So you want the two contracts to one another. So you need to be able to chart a particular spread on a chart. So instead of looking at the price of Bitcoin, you would need to actually look at the price of the dated future minus the Bitcoin. So it's really important you get a chart and you view it. So you do the December Bitcoin price minus the spot price and view this on a chart as a particular asset. Now, whenever you start any trading, right, the more research you do at the beginning, the better, okay? The smaller your amount of coins that you put in, to make sure that when you get involved, because you're going to make mistakes, you're going to learn, and you're going to learn a lot. Your steep learning curve in the first 5 to 10 trades. So we start small. You start with the minimum increment in those particular trades. We look at the charts. Crypto and digital assets, they trade technically extremely well. So some strong technical analysis on particular charts, but start small. Again, the best way to learn any particular trade is to get involved, right? You're going to learn more by actually putting on a trade, seeing the price action, i.e., let's say, for example, you're long the futures and you're short the spot. You've got a bullish trade, but watch as Bitcoin's going up, see if your trade gets into profit, and see then when Bitcoin goes down, see your trade go offside a little bit. So seeing that and actually feeling the pain of a trade is the perfect way to get into spread trading. I think the most important thing with any type of trading, any sort of investment, is you've got to understand your own risk profile. But the beauty of trading spreads is because the risks are far lower, far reduced than trading spot Bitcoin and spot Ether outright or perps. It's much lower risk profile. From a risk perspective and how much capital you need far less capital. So it's actually a fantastic way to get into the market, to learn and feel crypto markets, but trade in a controlled, lower risk environment. And that's the beauty of spread trading. The beauty of spread trades is that you can actually trade them at a higher frequency, maybe 20, 30 times in a particular day. Or if you don't have a time for that, you can certainly be trading it once a day, once a week, or even once a month. That's the beauty of the volatility in the crypto markets. Again, it's about what sort of P&L you're looking to take out of a particular trade, how much you're risking on a particular trade. But ultimately, there is opportunity at least to be getting in and out 20, 30 times a day if you are a full-time trader. If you're a part-time spread trader, you can certainly get away with looking at this and trading it in a daily perspective when you get home from work or at lunchtime. Well, fortunately, you can reach out to the sales team at EQONEX, and we're happy to walk you through the types of trading and help you set up. You can contact us on sales@equonex.com or myself directly. That's malcolm.baker@equonex.com.